Hey everybody, welcome to getting some feedback. Welcome to the morning market briefing, Friday, November 18th, 2022. Hope you're doing well. Hope the week has been strong. Hope you're looking forward to the weekend. Couple stories, relatively light news day, I would say, Tom, but we do want to open up by starting with some tech layoffs that we've seen. Really a trend that we've been tracking since I feel like mid to late summer, and just continuing to kind of ramp up specifically in the technology sector. What are we seeing?
Well, really across the board, we referenced the layoffs.fyi, which is the tech layoff tracker website, I think in our Q2
Yeah.
macro. And we're starting to see it tick up. And we've already well surpassed in Q4 where we were in Q2 and 3 in terms of layoffs in the tech sector. So I think we were a little bit early on calling that. But I mean, obviously, the big news everyone's seeing, it's all over the news this morning, is that Elon Musk basically issued an ultimatum and said, you had to turn in a form yesterday by 5 o'clock, basically saying you were willing to be, quote, extremely hardcore at Twitter or get fired. You get 3 months severance, but if you didn't basically turn in your form, they would consider you resigned and gone. And they have closed the office until Monday. Hashtag RIP Twitter has been trending on Twitter, but it still seems to be going as far as I can tell. But that's probably the biggest news one, but we had another couple as well.
People were definitely tweeting out like goodbye, like sentimental. Here's what I loved about this platform, as if it was breaking.
Yeah, people retweeting their own first tweets from like 2009.
It's definitely still working.
Yeah.
So that's one thing. I mean, the other thing is, I mean, I feel like in the tech world where people are so soft, the notion that you had to fill out a form and agree to be extremely hardcore is probably being ridiculed quite a bit. We make employees here do that every single day.
Yeah.
Like when you leave, you fill out a form that says, I, Andrew Hall, will be back tomorrow and will be extremely hardcore. And then you do it the next day and the next day. It's common practice, I think, for those that are out there just grinding like us.
We need to get a sign above the door, like at Notre Dame. You have to hit on the way out. It says, I will be extremely hardcore for Narwhal today.
we got to get something going. I mean, I don't know. I mean, it's a bold move to make people commit to working hard.
Yeah. And people hate it. And I think a lot of it is mostly just media driven. Obviously, Elon Musk rubs a lot of those people the wrong way. The people who love Twitter the most are journalists, and a lot of babies are upset about their wet diapers this morning.
Very upset,
particularly in the Twitter. I would say Twitter had too many employees. It didn't make any sense how many employees they did have.
It does seem like, to a certain extent, like if you're not doing new features, like it seems like you ought to be able to run pretty lean and mean.
Yeah. I mean, I don't know if this has been confirmed or not, but I did read a blurb the other day that said that they estimated the average daily food cost per Twitter employee was roughly $400. So there's either too many employees or they're all eating way too much food. And so
wild.
Talk about trimming the fat.
Yeah. They're going to get real lean physically.
Yeah. So on top of that, Andy Jassy came out yesterday afternoon saying that Amazon's going to extend their layoffs into next year. Looking to lay off about 10,000 employees, which is a lot of folks. But I mean, I think the trend, and we'll talk a little bit more about this, the next company, is that, we saw such a rush to tech during COVID. It seemed like demand was endless. It seemed like everyone was buying stuff online. Everyone was living online. And we're seeing that come back hugely. And there's a lot of trends, and we'll talk about Carvana as well later in the call, which is something that was very hot during COVID. We're seeing a massive unwinding of those trades. But Amazon really feeling the crunch. They built all this warehouse space. You couldn't find enough warehouse space for all the stuff, all the shipping, and now suddenly all those people working in those warehouses are going to be without a job.
Yeah, it's going to be messy. I mean, I think in a lot of ways, but I think it's probably the right move. I mean, I go back to some of the stuff we talked about in terms of being proactive and doing this before you have to. And I think that's probably what Amazon and others are doing. The Elon Musk Twitter situation is maybe a little bit more nuanced and more circumstantial, maybe less of a read through on the economy, more of a read through on the softness of Twitter employees. And I don't know, I'm coming off like I'm this huge Elon Musk stan, and I'm pretty neutral on the guy, but I don't know. I think people that work at these tech companies that are beloved by the media really lean into what heroes they are for writing code so that people can say dumb things on the internet.
Yeah.
Indian Uber also, their e-commerce firm GoTo laying off 12% of the workforce, about 1,300 employees. really pushed by inflation, strong dollar, over expansion. We'll come back to Carvana, but we also did hear from Christine Lagarde early this morning. I don't know if Ben got up at 3:30 a.m. to listen. I did not. I assume you did not, but
I haven't listened to it yet. I did read a little bit of the
you can
transcript.
kind of read the transcript and sleep in a little bit. That would be my general recommendation. But what are we hearing from the ECB?
I mean, there wasn't a ton of takeaways. They basically said everything that we've been hearing, which, you know, I continue to say, I think this strong market, this strong bond market, especially, is a bit of a head fake. Because she basically said she needed to, quote, rates needed to rise further, and withdrawing accommodation may not be enough. So not only are they saying we need to raise rates more aggressively, higher than people think, but they may need to enact additional restrictive measures in order to bring down inflation in the Eurozone. What that means exactly, I guess we'll have to see what the read through on that is as the sort of news cycle goes and wakes up here in the US and starts talking about it. But I'm not really sure what she means by that in terms of withdrawing accommodation. I mean, they're still buying bonds, but I don't think that's exactly what they mean. I mean, it could potentially mean they start actively selling into the market or restricting certain parts of the market. But, you know, we saw yesterday that the, you know, UK and Eurozone inflation continues to really fire strong, and we're not seeing that over here.
Yeah, it's interesting. I think in Europe, I think maybe in the US, there's problems, right? That if you listen to this call every day, you know that. But the problems, at least from a high level logical standpoint, if this then type situation, I think back to like 7th or 8th grade geometry proofs, the if then statements are consistent. If the if is met, then the then is met, and it seems to make sense. In Europe, both in the economic data and in some of the messaging and in some of the policy, there's a lot of contradiction, and that's where it makes it kind of difficult to define things like withdrawing accommodation. Even in the UK, looking at the tax and the budget stuff that we talked about yesterday, there's a lot of that geared at relief for consumer, but it's paid for by higher taxes, which is not going to relieve a lot of consumers. And so it's kind of this weird circular, slightly contradictory policy, and it's hard to really discern what is going to work. Here, regardless of the pace and the speed with which it is working, it makes sense to say we're going to reduce liquidity and we're going to raise interest rates, and hopefully that pushes inflation down. It's a little bit more binary. Doesn't mean it's necessarily going to work or that it's working at the pace that people want, but in a textbook, it makes sense. And in Europe, I don't know that it's that clear.
Yeah. I mean, like, there's a lot of talk about the swamp, right? That, you know, DC is a swamp and things move slowly, but I mean, relatively speaking, you know, it's not.
It's our swamp.
Yeah. The UK and the EU are a quagmire of bureaucracy, and I mean, really thousands of years of political, you know, maneuvering that's got all these weird laws in place, weird tax structures, weird debt structures, you know, that we just don't have. And part of that, I think, is just a function of not being in existence for 700 years.
Yeah.
For a lot of these countries.
Crude oil falling, now down below $80 a barrel. Not necessarily something I expected, but it does seem like there's themes maybe going on under the surface that could be having an impact on that, potentially even on demand, as we see things like China COVID numbers increasing, potential slowdown in U.S. manufacturing. What do you think is driving oil right now?
Yes, there are a bunch of different headlines this morning about this, and you know, I kind of just amalgamated them all in these notes, which is that, you know, some say, you know, it was Bullard coming out and saying we're definitely going to be raising rates 5-7%. That's going to slow the economy. Some are saying that it was Christine Lagarde saying that the Eurozone is at a higher risk for recession. You know, some articles are saying, hey, China, you know, now that they're doing getting rid of the zero COVID policy, suddenly everybody's going to get COVID, which is what we've seen pretty consistently around the world. When the restrictions lift, suddenly that thing starts spreading like crazy. You know, so they're worried that China is going to either just get overcome by COVID, or there's going to be massive lockdowns again. And so people are a little bit worried about that. And that, of course, is a massive source of demand for crude oil. And then, of course, we had a little bit slower manufacturing. People are worried that, you know, should a recession come in, we're going to be using less oil to manufacture here in the U.S. So, you know, we made a lot of jokes about, you know, never being able to refill the strategic petroleum reserve at $72, but, you know, give another couple of bad days on oil, and it may actually be a potentiality here sooner rather than later, they may actually start buying oil because it's going to be at a reasonable level.
Carvana, let's hit it at the end. I mean, just a disaster. I'm looking at the stock right now. It's down 97.6% from its all-time high. And you might say, well, when was that? How did that happen? It was last August. So barely over a year ago. It's down 80% in the last 3 months, 96% this year, 97% over the last year, almost 98% over the last 16 months, call it. Really, really, really in trouble. This is a company that was trading at $360 a share. It's now at $8.55. I mean, they're going under, right?
Yeah.
They're going to zero. I mean, this has to go to bankruptcy, it seems like. Where the bonds trading?
I mean, they're trading, I mean, in default levels. I mean, somewhere between 40 and 50 cents roughly in terms of on the dollar, which is, pretty much in default territory, which they're either anticipating they're going to stop paying altogether or they're going to go to zero. So you're basically in coin flip. Like, you're either going to pay 50 cents and you'll get $1 because they'll pay off, or you pay 50 cents and you're going to get zero because they're going to go to zero. I mean, this is basically just a Peloton on steroids because, used cars were so hot. Everybody talked about it. We talked about it on this call like crazy. So what did Carvana do? Well, they bought up a ton of inventory. And how did they buy that inventory? They bought it with floating rate debt. And so, what happened was they bought a bunch of assets. The price of those assets went down, and the cost of carrying those assets went up astronomically all at once. So they were thinking COVID's lasting forever. Used car prices are going to be up forever. We can do no wrong. We're just going to print money by selling, a $10,000 car for $15,000. Well, now, they bought a car for $15,000. It's worth 10, and they're paying 7-8% on top of that, just to hold it in inventory because they use debt to finance that. And it's just, I mean, they're in a debt spiral, and I don't know what gets them out, because if your bonds are trading in default level territory, you can't go back out and borrow money from anybody else. Because if I, say I'm going bankrupt and I say, hey, Andrew, I'm going to borrow money from you. Well, the way that works in corporate finance is that now Andrew stands behind all the people who I already owe money to. So if I go bankrupt because I can't borrow money, then not only is he going to lose that money, but he's also going to be behind every other debtor I have and probably not get paid back. So what incentive does he have to give me any money? And it doesn't really matter what the interest rate is or what the terms are, because you'd have to hold that money for some period of time to get paid on that. So if it just goes zero, I mean, it's gone. And they burned $2 billion in Q2, and they stemmed that pretty significantly in Q3. It looks like they burned around $188 million. But S&P, the big ratings agency, has basically said they're expected to be broke by mid to late 2023. So
it's brutal, man. I'm looking at their site right now. I mean, I will say used car prices definitely come down.
Yeah. So
which is not helping.
Yeah. If you need to buy a new car, if you can hold on for another year,
Carvana's going
to have a lot of used cars on fire sale. So yeah, something to keep an eye on. But, it was one of those companies that they were they were a darling, hedge fund darling. They operated at a loss for a long time. Suddenly they started making money. They thought they were geniuses. They were going to lever to the hilt, and then bang, they'd be dead in the next 18 months.
It's crazy. It's crazy. I mean, maybe the first big name company that we see truly go under during this recession. I'm sure there'll be some others. I mean, thankfully, you never root for bankruptcies by any means, but this is kind of an attempt at breaking the traditional used car market where they overextended themselves. It's not like we're looking at this 100-year legacy business that just couldn't make it through this downturn. They flew too close to the sun.
Yeah.
They borrowed too much money. They bought too many cars. They didn't sell enough. They're paying too much interest.
It was their own fault too.
Yeah.
It wasn't like some sort of external shock.
They got cute.
Yeah. They were like, hey, we're going to financial engineer this thing and we're going to make more money than we were making. And then suddenly they're making no money and losing money hand over fist. I mean, Bed Bath & Beyond. I mean, the thing about capitalism is that, outside of the fact that we paid out a ton of money to keep companies alive during 2020, is that dinosaurs will die, survive and advance. And if you're not operating at a level where you should be in business, you probably shouldn't be in business. And Carvana is a great example of that.
Yep, definitely. All right, we'll wrap it up there. Hope everybody has a great weekend. We will be back. We're going to do calls next week just on the programming side for everybody. We will have calls on Monday Tuesday, and Wednesday. No call on Thursday. Thursday is Thanksgiving. If you're local here in Marietta, running the gobble jog when you're coming up Chicopee and your heart's breaking on that hill, stop by the house. I'll be handing out mimosas in the front yard. So hopefully see some of you guys. And no call on Friday of next week either. We will have some folks working, but going to be kind of a bare bones crew. So no call Thursday, no call Friday. We will be here Monday, Tuesday, and Wednesday. Y'all have a great weekend.